Let's welcome on board Gautam Dugar from Motilal Oswal Securities. Gautam, hi, morning. Just debating whether the market has run its course and the adjustment of the corporate tax rate cut is already in the price or not after that 8.5% move that you saw on the index alone on Friday and Monday.
Yeah, hi Aisha. Good morning. I don't think one can look at an event of such magnitude from a prism of 2-3 days of index adjustment. Well, obviously the initial reaction was very swift, but I think one has to understand the fact that this tax benefit are going to be there for perpetuity, and therefore the adjustment in cash flows, free cash flows and earnings, and more importantly the ROEs of different sectors have changed sustainably because of this one move. So while in the short term market may move here and there, but this is clearly a re-rating event, not just from a point of view of few sectors, but from a point of view of country also, because you are changing the ROEs sustainably towards on the higher side. And therefore to debate this or look at this from a point of view of few days of index adjustments or few sectors swift run will be bit erroneous.
Okay, so what would be your strategy then at this point, Gautam? Would you be sort of reallocating at this point, fresh additions, waiting and watching? What would be the correct strategy?
Yeah, so there's been one small change in our strategy. If you recall, a week or so back on your show, I had said that we are very positive on IT and other defensives. So that is one change that we have made. Incrementally, we have shifted or some sector rotation from IT towards domestic cyclicals like financials. We continue to stay positive on consumption because they're also one of the big beneficiaries of this, and they already have a very high ROE. And growth prospect can improve given that there is a sentiment change overnight. So possibly after a couple of months or quarters, you can see some consumption direction also improving. What has also happened is some of the other sectors like pharma or utilities haven't seen any meaningful benefit, because in utilities it is anyways a pass-through kind of an arrangement, and pharma by and large most of the companies are already low tax paying. So you will see some sector rotation from sectors like IT, pharma and utilities towards sectors like financials and consumption, and at the margin also some of the industrials like capex oriented sectors, because the immediate reaction from this move is that over a period of time this can lead to improvement in the investment cycle, which has been virtually stagnant for last 7-8 years. Once the corporate savings go up post this move, you will see an improvement happening on the investment cycle, but it will take some time. It's not going to happen tomorrow or next week, but it does bring the conversation on investment cycle back on the table. So those are some of the moves. Slightly less allocation to defensives now and more towards domestic cyclicals, while staying as positive on consumption as we have always been.
The other debate, of course, is, Gautam, do you stick it out with the safer lot, the large caps, and continue to deploy money in those expensive Nifty names? Or do you think, higher alpha generation is possible within the mid and the small caps? And after this big event of the corporate tax rate slash, there is a case for the broader market as well to recover.
Yes, I tend to agree with that view. However, with a caveat that you will not see all sorts of mid caps participating in this rally. First, the large caps will always move, and that is what we have seen. Even in those 2 days when the markets rallied sharply, Nifty has outperformed the mid cap and small cap indices. And even within Nifty, we have seen around 10 or 15 companies again leading the charge, largely belonging to consumption, auto and financials. The fact of the matter is, this move, if you look at it from a long-term prism, is beneficial for companies with a high growth and a high ROE. Theoretically, it should lead to a jump in their earnings multiple, whether it's a P by E or a P by B. It's a separate case. As far as mid caps are concerned, when I look at the data, I was looking at this data yesterday for both mid cap and small caps. Small cap index is still down 36% from December 17, and mid cap index is also down more than 20%. So there is enough room for mid-cap to perform from here, because what mid-cap was lacking was the confidence and the risk aversion. This step of the government has removed the risk aversion to an extent. If you see some earnings coming back over a period of time, there is definitely a case for mid-cap to outperform from here. Again, within mid-caps, you will find some sectors will take more dominance, especially on financial side, because their ROEs are getting an expansion of 100 to 200 basis point. Secondly, sectors in mid-cap belonging to consumption or consumer discretionary will see more preference over there. So you will not see mid-caps which have some stress on the balance sheet or lack of earnings visibility performing despite this move. Within the mid-caps, you will find the quality mid-caps and companies without any stress or issues on their balance sheet will outperform. But clearly, as a pack, we think that from here mid-caps can outperform.
Okay, so clearly bullish on mid-caps, high-quality mid-cap stocks to perform well. But the focus there will be on quality, as you're saying, Gautam. When it comes to some of the perhaps consumption plays that you're finding attractive, there's been a lot of talk about whether or not valuations justify perhaps adding more into those counters. On the other hand, we're still awaiting any further rate cuts or boosts that we may see to the economy and to demand going forward. What's your outlook? What's the kind of the kind of potential you see on some of those names?
See, consumption, even 6 months back, nobody said it is cheap, or for that matter, even 3 years back, those stocks were never cheap. And this entire, cycle of last 5 or 10 years, one has always found consumer companies expensive. I don't recall anybody saying Lever was cheap at 600 or 800 rupees. So at 2000 rupees, obviously, it is not cheap. The fact of the matter is, most of us are trying to look at consumer stock from the prism of 1 year forward PE. Which I think is a bit short-termish, while no one can deny that in the short term their valuations are expensive. But the fact remains that, this step, particularly from a point of view of consumer sector, there are two indirect benefits, which is that, unorganized sector, which has a huge advantage as far as tax arbitrage is concerned, that arbitrage gets narrowed. So post GST, this is another step which can further the shift from unorganized to organized. So it's very beneficial for the leaders in respective categories in those sectors. So companies like Hindustan Lever, companies like Titan, or for that matter even Page, Pidilite, Asian Paints, these are companies which were high tax paying. They're getting two meaningful boosts from this. In the short term, obviously, you're getting a tax benefit, and from a longer term perspective, you're getting a market share gain. And obviously, it changes the scale of competitive advantages for many of these companies. So I think in the short term, it is very difficult to forecast what will happen. And that is the framework that we have always followed since last 4 years. We have backed a couple of these names since last 4 or 5 years now in terms of our preferred choices. And while they've been expensive, they've kept on getting more expensive because the earnings growth outlook was relatively better in a market which is hungry for earnings growth in other sectors. So I think this shift will continue to play out, and it will frustrate people who are looking at the stocks from a point of view of 1 year forward PE.
Okay. Gautam, though, on the subject of consumption, many believe that perhaps it would be more worthy to stick by with some of the investment-led themes. A lot of cap good companies, road construction, etc., is what is finding favor as opposed to pure play consumption. Is that your view as well, that there is a higher degree of outperformance within that segment as opposed to consumption?
Yes, but there is again a caveat. See, investment cycle will take time to revive. It's not going to happen in FY20 post this tax cut. But what has changed is that the corporate savings will go up. If you look at the Nifty estimates itself, in our estimates, we are seeing 30,000 crores of extra profit for FY20 itself. And of course, that will keep growing, year on year. Now, the point is, first, the sentiment has to improve, then the demand will come, and then the corporates will start thinking about investment. Right now, their capacities are underutilized. If you break sector by sector, the biggest beneficiaries of this tax cut is financials and consumption. They don't need any fresh capex. Metals is already in a deleveraging cycle. I don't think they are in even thinking about a big fresh capex. Similarly, cement, there is enough capacity in the system which doesn't need any fresh immediate capacity boost. So investment cycle will happen. But not immediately. It can be a FY21 or a FY22 story. The good thing is that now both the fiscal and monetary policies are supportive of growth. So your interest rates are also lower, and at the same time you've got improvement in corporate saving post this tax cut. So this clearly improves the visibility on investment cycle coming back. The problem is it will not happen immediately. And the second problem is to find relevant investable plays in that space. Today, aside of L&T, the choices that you have from a point of view of playing investment cycle are very limited. You will take 3-4 capital good players and couple of cement companies. Beyond that, to hunt for a lot of investment cycle plays, it's a challenge for capital allocator today.
For joining us this morning.